Okay, so I want to welcome everybody. Thank you for attending. Appreciate everybody being here. Just want to start out with who I am. I'm Ellen Schroeder. I've been with Out of the Box Technology for what seems like eons now. So from the very beginning, I think at least 10 years now. So as I said, I'm handling this for Jennifer, who usually handles our Technology Tuesdays. We used to do these a long time ago, and then we got real busy, and then we got Jennifer, and we said, man, we got to start these up because there's really so much to talk about with QuickBooks and things that relate to it and that sort of thing. Again, I just want to remind everybody about what Out of the Box Technology does. I mean, and if you've been with us for a long time, we have certainly grown. We started out as a QuickBooks consulting company, the training, and then we got an integration team, software designers on our team. We do hosting, support, bookkeeping, all of those things that you see right there. So really, we truly have grown and continue to. So it's been real exciting. So we can cover so many things for small business owners. And we have this awesome product, Recur 360, that we actually created, thought of, listened to our clients. It's all about recurring invoices and collections. And Lisa and Andrew, those are our co-founders there. They were recently on the cover of that CFO Tech Outlook magazine. So we can send you the link to that. It's pretty great. It's even on our website too. So we're pretty proud of this and the solution that we created. And now on to what we're talking about today with Mike Millen, Speed of Cash. He's oh, there you go, Cash Flow Mike. So I'm just going to leave it up to you, Mike. Do you want me to? I can make you presenter, and then you can show your screen if you have PowerPoint to show. Do you
sure.
have that, or
yeah, I am set up. I am ready to go.
Awesome. So let me give you. I'm going to change presenter. Okay, I'm going to make you presenter here. Hold on.
Okay.
Wait a minute. Again, guys, thank you so much for being patient. There you go. I'm going to make Mike Millen, the presenter. There you go. So you should be able to show your screen.
Oh, wow. I didn't realize that was this. I looked like this morning.
That's the first thing I do. I turn off the webcam. I know that.
Show the screen. Let me ask you what you can see as far as my screen.
Well, we see cash flow tool. Unlock your cash flow today. That's what we're seeing.
Got it. All right. So I'm going to have to extend my screen because my picture is too big. I can't see what I'm reading. There we go. Get that set up. And we will be rocking and rolling.
Perfect.
And maybe.
You're somebody who works with a lot of different screens. There we go. Oh, there we go. You see it now. We see the PowerPoint.
Generally not. But I am. Okay. Good. All right. Well, hey, Ellen, thank you. I know. Here's what the cool thing is. I think it was QuickBooks Connect. I'm going to say 3, maybe 4 years ago that I'm Out of the Box Technology, and we've just kind of known of each other and kind of played in the same circles. And I think this might be the first time we've done anything together.
Yes.
So I think this is really exciting from my point of view because, A, I get to work with you guys. First of all, if you don't know about Finagraph, Finagraph has about 6 different products right now, and most of them are in the banking side. So, I mean, we like to call ourselves PVC of banking, right? Which means we're built into a lot of things. You don't see it, you just know it works somehow. You just know that the sink's drained. And what we are is we consider ourselves to be the best at gathering data from accounting systems or from tax returns or otherwise, where we can digitize and normalize data and map it into other software programs. So that's what we do on the highest end. Some of the companies that we work with that you might be familiar with, one is Moody's Analytics, who is also an investor and a strategic partner, and they work with large banks like, Wells Fargo, like CIBC in Canada, or like CAB in Australia. I mean, they've got some of the largest banks in the world that they work with. And our relationship with them gave us another relationship with a company called PayPal, and yet another one with a company called American Express, who we're actually going to do a large program with. And you'll see it, probably everybody will see it because they're doing the marketing effective third quarter this year. So here's what we exist to do with our own products, not just the ones we build into banks and otherwise. We exist to eliminate cash flow as the reason that people fail, much like Recurse 360 is trying to solve what I consider to be the speed of cash. It's kind of a term that I've coined over the last 5 years, which is that's how you stay in business. That's, keeping a business in business is what that's about. It's about money moving through your company at the right speed, not too fast, not too slow, which it's just as easy to grow broke as it is to go broke. So you can be too successful and actually lose money. Here's the stats behind why we exist again. 28 million businesses. Every 3 months, about 200,000 fail. About 82% of those have cash flow as a problem. The interesting stat I always point out is 35% of every businesses that fail actually make money, which means on paper they make money, they just run out of cash, and that's the growing broke problem. So that's why we developed Cash Flow Tool, and what we're trying to do is put the focus on cash instead of paper products. Again, much like I think what Ellen and her company are doing over there with Recurse 360 or Lisa, is managing the components that drive cash through a company, which is your receivables, your invoices, your payables, your inventory levels, and all of the things that kind of suck up cash. And because we're banking focused, bankers lend on cash flow, they don't lend on profits. So that's some of the things that we're trying to highlight is here's what the bank looks at. So when you look at the cash flow tool, those are what you'll see. Specifically, one section that's called the speed of cash shows you how to manage a short-term line of credit. A lot of people don't know how to do that. They'll actually go into the bank and say, I need a line of credit, and they know they need a line of credit, but then the first question the banker asks is, well, how much do you need? And then the business owner almost always says, yeah, I don't know. I don't know, how much will you give me? And that's one of the first questions that the banker asks that tells the banker that you don't know how your business runs. So what I'm hoping to do is illuminate some of the levers that you have as a manager to be able to put that information in your fingertips, because what Cash Flow Tool does is actually show you where you're short, if you're short, and how much you need to cover that gap. And when I talk about it, really is the financial gap. Let's see here. So I have an explainer video, but I'm going to go past that because I want to put you right in the product. I don't want to give you the overview of what we're trying to do. But basically, in a nutshell, we're doing automatic cash flow forecasting, giving you as much control as possible. We've got like 5 different financial models that are built in. You just select it, and you can select it per customer or per vendor. It doesn't matter. And then we create a 13-week calendar going forward of what your cash projections will look like. And you're not typing anything in. If you don't want to, you don't have to. But you can. You've got complete control. We're giving you some guidance and then seeing anomalies. People say, well, cash flow is what QuickBooks does. They have their own thing. Well, they're not pointing out the anomalies. And the anomalies that we look for are things that are just outside the norm, such as your water bill is usually $15 and now it's $40. It might be something you just write a check for, but if you didn't see the water leak out in the yard because it was wet all spring, you might be just wasting money in the form of just leakage. So that's just a small example, but we're looking for anomalies where things aren't as they seem or aren't at what they used to be by evaluating history. So just some of the things that we put into it. And again, this is just kind of getting the process started, is knowing about the future, never being surprised. Some people say, I don't have a cash flow problem, so this isn't for me. Well, I can tell you that, even my partner here, James Walter, he and his partner had to come out of pocket for $100,000 in a large company just because they got surprised by payroll when they took on an account that was larger than they expected in their home healthcare business. So, it's everybody's dream to get that Costco contract. And I've got a friend named Alden Mills who built a product called the Perfect Push-Up and almost lost the company when it became successful, mainly because The orders are coming in from Costco. The orders are coming in from Target. Yet he's building and filling the orders and waiting 90 or 120 days for money to come in. So that's what we're talking about, is that speed of cash. Yeah, somebody got a question? I've kind of just talked a lot there to get things going, but to demo it, let me show you what we're trying to do. I'm going to switch slideshows to my educational portion of speed of cash and just show you what I'm talking about.
So Mike, I have a question.
Sure.
So is this something that would just lay over like the top of QuickBooks, or is this just another dashboard, or how would it look like to me as a small business owner? Maybe you're getting to that.
Yeah, that's basically what I'm trying to do. I'm just trying to, the first part there was kind of setting up who we are and what we're trying to do. Here's the big problem, right, is the speed of cash. But yeah, it is an add-on for QuickBooks, much like, thousands of them that are out there in the ecosystem. It kind of overlays over the top of QuickBooks. If you have a desktop version, we're actually built into the company menu. So, if you want to connect and update your data, you just go to the company file menu, drop down, it says Finagraph Connect, you press it and it updates the financials. We are mobile plus desktop, so you can have either experience. And I think what's happening is that accountants are liking the desktop version because they can do all of the setup from a desktop. But the business owners are actually preferring the mobile version, right? Because they're out there doing their business, they're out there, working in their business, so to speak, but yet they get the notifications at the right time. And when I talk about the speed of cash, this is kind of what I'm talking about. So, and I'm going to go over the top 10 reasons that businesses fail, but mainly 7 of the top 10 involve poor cash flow management. Specifically, I'm focusing on, cash flow rather than profit, the relationship between receivables and payables, probably a lot of what Recur 360 does, paying too quickly, carrying too much inventory, best practices for invoicing, extending credit to the wrong folks. Those are the issues. Those are really symptoms of the bigger problem. These are contributors, right? I like to call them watch-its. That doesn't mean you have a problem today, but it does indicate that they could contribute to a problem in the future. So where do we look? What are we doing? What is it? What is this? I was like, so my whole philosophy, and you're like, well, why should I listen to you, Mike? Well, I teach small business banking at 3 of the top 5 banking programs in the country. They're at the graduate level at LSU, Colorado, and the University of Washington. And they bring me in here to teach bankers how to work with small business owners. This is the 10th company I've built. And because of that, I think I have an understanding of how to work with a bank, right? And because of my own experiences, when I tell the stories about the way a banker should work with a small business, they're hearing it from my point of view, not just another banker telling them what to look for. And in general, I say, you need to run your business, first of all, as if you intend to sell it, which means, when you put your house on the market, when you try to sell your car on the market, well, the first thing you do is clean it up, right? You clean it up, you fix some of the things that are broken with it, and all of a sudden you get the benefit of a cleaner house or a cleaner car. That's the same thing you should do with your business. But beyond that, your business should operate like a machine, right? That's where you're seeing words like gears in here, right? So when I talk about the speed of cash, I'm talking about gears between companies, which is, money coming in versus money coming out. So we have the money coming in, the inflows, or your working capital, versus the outflows or the cash that you have on hand that's used to pay your payables. And I'm putting some words behind it. A high-speed gear is what should be coming in. A low-speed gear is what's going out. And I want you to think about that in size. So a small gear goes fast. A big gear goes slow. Just in our mind, the ways we perceive things moving, even if they're moving at the same speed, because our business moves at the speed of each day. But it's a high-speed gear coming in, a low-speed gear going out. It seems pretty intuitive, but it may be one of those things where we're just not managing it to that level. Now, in this example, we're going to look at 3 things specifically. And by the end of this hour, Ellen, you're going to be able to say, oh, this is how much I should ask for in a loan. So it's kind of my goal at the end of the day, because when you see the speed of cash dashboard in our product, that's exactly what we're gearing towards is being able to tell you how much to ask for in a loan. So the things we're going to look at are some of the drivers of the cash conversion or working capital cycle, which is your accounts receivable, your inventories, and your accounts payable, which is things going out, things coming in, and inventory you have in your shelf, versus your cash on hand, which is the money that you have available to make payments. Now, cash on hand is kind of a misnomer because it assumes low or no sales. What it can help you do is determine, well, how long will it take me to go bankrupt if I have to close this down, or it will tell me, can I live through my seasonality? If I have a 60-day seasonality, maybe I have slow sales in June and July, I need to have at least 60 days cash on hand to make it through there with very little problems. So those are the three numbers I'm going to be paying attention to and talking about. So we're talking about the driving gear, which is small, very small. First of all, let me explain what working capital is, right? It's nothing more than current assets minus current liabilities. What most people don't know is when a bank looks at your balance sheet, they assume that your current assets can pay for your current liabilities, or does your business generate enough cash to just support itself? Additionally, they've got the fixed assets, your buildings, your equipment, things like that, they assume are paid for with long-term debt or cash or long-term liabilities. So that's the kind of way they dissect your balance sheet. Remember, so this is the cash flow to them, working capital to them, EBITDA to them. EBITDA is another term that you'll see used by banks, means cash flow. Sometimes people refer to it as a cushion, and that's really what we're looking for, is how much really cash do you have after you pay your debts. It can be expressed in both a dollar or ratio. There's only one big difference between do I subtract or do I divide. A ratio is really just a super quick example. You take an example of a current asset, we'll say a checking account, versus a current liability, we'll say a credit card. And whatever the resultant number is, we'll say in this case it's a 2. Your current ratio is a 2, which is actually a good current ratio to have. That would mean for every dollar you owe on the credit card, you have $2 in checking to pay for it. So that's kind of how you read those ratios. Inside cashflowtool.com, everything that I'm telling you right now, there's a 1 or 2 minute video. If you forget anything I'm saying right now, don't worry. When you take the trial of cashflowtool.com, go, oh, he said current assets or he said current ratio. You click on explain now, and I'll show you that here in a few minutes when I get to the product. Hey, Ellen, you don't mind? I'm trying to do some education before the product, right? Because sometimes when people see sometimes people see the term. Okay, cool.
No, that's good. That's good.
All right, so really what we're trying to do is understand the financial gap. And rarely when I talk to accountants or business owners do they understand that this is really what the bank is calculating, the financial gap. You might know they hear other names for it called the cash gap, but this gap is the super important. This is the driving gear. We're trying to measure the gap, and you want the gap to be small. That's why I keep referring to a small gear. So this financial gap, this financial gap or the cash conversion cycle tells you the amount of time where you've run out of money. You've already paid all of your bills and you're waiting for money from your customers. That difference in time is called the financial gap. Your line of credit that you get from the bank is designed to cover that. So when they do calculations in the bank, they take it in the back room, they say, hey, they need $110,000. And they did that by taking the amount of cost of goods sold you have. That's why I've got cost of goods sold down here divided into days. So if I have $100,000, I'm probably going to do weird math, $100,000 in cost of goods sold divided by 365, what's that, $3,650 a day times your financial gap days. That is your line of credit ask. And I'll go through an example of that. So this financial gap is the driving gear. It's what everything goes together. And if you notice, it's the 3 levers, the inventory days, the AR days, and the AP days. Inventory plus AR minus AP equals financial gap. Here's how it looks in life, right? Can you guys see my mouse when I do the mouse? Or do I need to?
No.
You
No, I
can?
can't see that. No, but
while I set this up.
No, but now it's yeah. Okay, now try maybe.
Okay.
Oh, there it is. I see it. I see it.
You see the mouse now?
Yep. Yep.
Okay, so basically, I'm starting right here. This is the. I guess I'm shutting it off.
Oh, that's okay.
Yeah.
I mean, the graphics are good, so we can.
All right, so right here at inventory days, we're going to assume this is how things happen, right at inventory days, without clicking past it. You know inventory sits on the shelf, so you've ordered inventory, it sits on your shelf for an amount of time, and then somebody buys it. And let's say they buy it on credit, then the invoice sits on their desk for a certain amount of days. So by the time you order the inventory to the time you get paid is one length of time. In the meantime, you've bought the inventory, but you got an invoice as well, and that invoice sat on your desk for a certain amount of days before you paid it, right? The difference between those two is called the financial gap. That's the focus, right? That's where we're trying to understand how much money do we need. So we convert, if you notice this, there's a lot of conversion of ratios to days. Like, there's an inventory turnover rate, we'll say of 4, but when you convert that to days, which is 365 divided by 4, it's 90 days, right? So I think your inventory sits on 90 days, your AR sits on somebody's desk for 34 days, your AP sits on somebody's desk for, we'll say, or your desk for 56 days. Those are the numbers we use. Now, Ellen, you probably don't know this, but I was a state trooper for 7 years, and we used to measure speed in miles per hour, but now it's days.
Oh, okay.
Good. So, all right, so that's what we're looking at. So linearly, this is the top line is money coming in. We're waiting that long for money to come in. And the bottom line, inventory and AP days, is money going out. That's how long it takes for us to exhaust our funds. Okay, so here's how they're calculated. I won't go into the calculations. It's on the back of every card and cash flow tool. But really what we're talking about is how long does the product sit on the shelf, how long does it take a customer to pay, and how soon do we pay our suppliers? And again, there's the calculations that go with that. So here's kind of a sample problem, meaning that I took that balance sheet and income statement that I showed you in the very beginning and just took those numbers off the balance sheet and income statement, right? So these aren't new numbers. These are numbers that are in the very beginning of the presentation right here. You guys remember that?
Mm-hmm.
And I'm going to use them now just to do some basic calculations. So there it is, current assets, current liabilities, receivables, payables, sales, cash on hand. First of all is the working capital calculation, right? This is, do I have a cushion? So I have current assets, which is my checking, receivables, inventories of $2 million. I've got current liabilities about $1.5 million, which gives me working capital of $530,000, which seems good. You're like, oh, I got about $500,000. The thing is, you don't know if it's enough. You just know it's a number, right? And it's positive. What we don't know is that it's enough. Taking the same exact numbers and turning them into a ratio, it comes out to a 1.35, right? The same numbers just divided, not subtracted. That means for every dollar we have in checking, every dollar we owe on a line of credit or credit card, we have $1.35 in checking. That's basically what that is saying. So we have positive working capital at $1.35. This is more. This is a little low. It's still fair. I would call it, if we're looking at good, fair, terrible, it's still fair because we can at least cover our own expenses. But the number that we're looking for, or the answer to the banking test, is 2 or higher. That's kind of what we're looking at.
Mm-hmm.
So you can have positive, neutral, or negative. When you do these calculations, it's going to be one or the other. Of course, you want positive working capital, but that doesn't mean that negative is always bad, right? There are some high-growth companies, we'll think SaaS companies like Finagraph, where there's a lot of research and development that goes into the front end before you even make one sale. You can think Instagram, right? They raised $50 million and sold for $1 billion in 4 years just based on user count. So negative working capital isn't always bad, but it really works on back-loaded subscription-based models. The neutral working capital, if you wanted to go look on that, this is what got the car industry into trouble, was the neutral working capital, where they were trying to do not just in-time inventory, They were just trying to time the receivables and payables to be equal.
Right. I have to tell you, and Mike, this is kind of funny because when you started talking at the beginning, I used to work at Ford Motor Company at the headquarters in Dearborn, and that's what I thought you were talking about, because I thought that was and we did stories because I worked in the news department there before, and about the just-in-time inventory management. I mean, I thought, wow, this kind of sounds just like that, and it was. I always found that interesting how such a big company was going to try to do that, make time everything so that they didn't have a lot of extra inventory on hand. But wow, that was a huge undertaking. But I understood.
Well, and the thing is that there's so many moving parts. You're always beholden to somebody else when you're trying to manage it that closely. So, neutral again isn't as bad, but it's you're just really a pass through, right? As soon as money comes in, it's going out. So that's what working capital is. Okay, so how do we calculate the financial gap? All right, so firstly, we've got you've got your inventory, AR, and AP days. And what I did is I went ahead and calculated those using those sample numbers. And Ellen, anybody wants this slideshow, I can send it to you as well.
Yeah. Okay, that sounds good.
Right, where they can kind of go back through it and do the math and understand it. But I tried to spell everything out. Anyway, we come up with, using the sample problem numbers, 90 days of inventory, 34 days of AR, 56 days of AP. So you take inventory plus AR minus AP, that equals your gap days. So we've got the 90, the 34, and the 56. So here's how it looks, right? Inventory sits on the shelf for 90 days. Then we wait 34 days for somebody to buy it. So that's 124 days to collect money. Then we're paying our bills in 56 days. You can see how the gaps already started to develop, right? So you've got 56 or 68 gap days. When you take 124 minus 56, you get 68 gap days. What this is used for from here is to come up with how much money you would need. And let's just keep it at inventory. Say, I'm not going to include everything in accounts payable. Now, I would, because I have to pay rent and I have to pay salaries and things like that. But again, let's go back to, I've got $100,000 in cost of goods sold in a year. You guys follow me there? 100 in a year, 100K. Yeah, that's terrible. And we divide it by 365. I think that's $3,000 a day, isn't it?
You have the calculator in front of you there, probably.
Maybe it isn't. Nope, I'm sorry. Divided by 365. Nope, it's only 200. It's 300. About $300. So we'll just say $300 rounded. Right, $300. You take that times 68, because that's your gap days. So 300 times 68. That equals 20,400. That would be the amount of money we would be short. Right, so that's basically what we're saying is that, hey, we would be short for our financial gap, $20,000. The thing is, back on our other calculation, we knew we had working capital of how much? 530. So our shortage is 2,000 or 20,400, but we have working capital of 530. We're okay. We don't need any more money. You guys get that? So you take your 530 is what your cushion is, and in order to run your business, we needed 20,400. In this case, and I just used a weird number. Let's use the actual number just to see. So if I take the eraser and not use these numbers, what was the actual cost of goods sold? You see that's 4920, 4 million, right there, 4,200, 4,920. We're going to divide that. I'm sorry. If I can divide, not multiply, we're going to divide that by 365. Anybody got a calculator? 4920 divided by 365 equals 13,479. So we'll just say equals 13.5 per day. Now, what I use that for is saying, if I continue to sell, I'm going to need $13,000 a day for the inventory. Does that make sense? So in here, if I can't cover 68 days, that means I can't cover 68 days of inventory that I have to buy. So I've got 13,500 is my number. Not divided by, that's now gone because we already did the calculation. It's multiplied by 68 equals times 68 days, 916,602. So we have a shortage in this company now of $900,000. Our cushion that we subtract out was 530. Because that's how much we have available. So minus 530 equals 386,602. Now, here's what you do with that number. I go into the bank, and instead of saying, hey, Mr. Banker, I need a loan, and they go, how much you need? You go, I don't know how much you give me. That's one way to tell the story to the bank. You got to remember, the banker is an advocate for you. The banker is the one that's going to help you get the loan. In this case, you go in there and say, hey, listen, here's how my business is currently running. I've got 90 days of inventory. My customers are paying me about 34 days. I'm paying my bills in 56 days, which gives me about a gap of 68 days I have to cover. Based on the amount I'm selling, I need $13,000 a day. I need 68 days covered. I need $900,000, but I have $530 in working capital. So I'm going to ask you for $400,000 to cover $386. Once you do that, you start to understand you're asking them for the right money. You know it. And I know I got a little bit deep, but I'm showing you the calculations that we're doing. So when you see the product, I can just point to these numbers and say, here's what I was referring to. Does that make sense?
Yes.
Yeah, how many did I lose? How many?
No, everybody's still here. So no,
Okay.
No. I make this to see. I like this background. It'll be good to see that, the product and how with the numbers in it. Yeah.
Well, some people will say, okay, well, how's this different for a service business? A service business, you have to know two numbers. One is you have to know what your average payroll is for your company, and then your average collection days. So, for instance, I had a hotel staffing company where I was paying about $100,000 in payroll every 2 weeks, right? So we'll say every 2 weeks, all of my employees, about $100,000 went out to payroll. Now, using the same type of graph, I don't have inventory. Inventory would be zero, so I can ignore it. But my AR days were 45 days, which means Marriott, Hilton, all of those companies who were paying me on average 45 days. In 45 days, I would do 3 payroll periods, right? Because I'd have 2 weeks, 30 days, 44 days, right? So you got, it's 14, 28, 28 and 14 is what, 32? So that's how you calculate that up, and each time was 100,000. So the way I calculated up my line of credit need would be how many payrolls do I have to cover in my collection period? And that's how you do it for a service business. Does that make sense? Okay.
Yeah, we're getting some good response from people. They like to see, they need to put their numbers in, but they like the explanation.
Hey, you know where they can put their numbers in? Cashflow Tool.
Oh my God. Yeah.
Okay. And the last thing I'll do before I go over to and demo the product is the driven gear, and that's really what we're talking about is days cash on hand. And the way we calculate that is cash on hand divided by operating expenses divided by 365. And here's the legend. Here's what you want. Right? You want 45 days or more. That's at all times you want to have about 45 days or more. This company has 17. So 17 kind of tells you this. This is the legend. Less than 0 is bad. 15, you're in financial trouble. 15, 45, a little cushion, but you need to stay on top of it. So if you need a goal, try to keep that at 45 days or more. If you have seasonality that's 60 days long, going into that, you should have enough cash to last 60 days in case you don't have any or low sales. What you're trying to do is make sure you can meet your fixed expenses during those slow seasons. That's how you use cash on hand. So we want that number to be big, right? 45 days or higher. You want your financial gap to be low as you can get it. And you do that by reducing your inventory, by collecting faster, or by paying slower. Those are 3 different ways you can control your financial gap. So here it is, controlling your speed. Again, driving gear means it should be turning fast, so fewer amount of days. Driven gear, it should be turning slow or lots of days. Those gears are actually on the cards inside the product. Are we ready to see the product? I think we're up on, we've got about 25 minutes left.
Yep.
And that's about the right time.
Yep.
Cool. Let me get to the product. Okay, what can you see now?
Big Dog Contractors and Freddy's Hardware.
Okay, so what you're in is when you first log in to cashflowtool.com, and for those of you who don't know, you can just go to cashflowtool.com, and then there's a try free button at the top left, and I'll just kind of show you where that is. So if you go there, I don't know why. Yeah, there it goes. Internet must be a little slow, but there's a try free button that anybody can try it with. Works with QuickBooks Online, QuickBooks Desktop. Okay, so back to here. When you first log in, this is what you're going to see. If you only have one business, you won't see the other 2. You won't see Freddy's Hardware or Rick's Bike Store. You'll just see that. But if you're an accountant, you can quickly see all of your clients on one page. And the thing that stands out immediately to most people is these 2, February, March is the cash flow projections, right? This is just a thumbnail view of our cash flow calendar. And it's designed to say, okay, the greener it is, the more cash you have, the redder it is, the less cash you have. So you can say, who needs help today? I can scan down through Rick's Bike Store is going to be in trouble. I need to go, see what's happening. So I can actually find my customers who are in trouble today and actually kind of intervene and say, hey, listen, here's what's going on. It tells you how much they cash, how much cash is on hand, and they don't have a lot of trouble, but I'm just saying if it was red, there would be a little bit there. So let's kind of dig into the details now. So each one of these is just kind of a snapshot view of what's going on. But if I dig in, just click on Rick's Bike Store, I go to the details behind the details. We've got 4 different sections. One is just a dashboard with the most common and useful ratios. The next one is the cash flow calendar. Then we have some alerts and notifications, and then a full document center. So each one of these we call just cards, and they're just little bits and pieces of information about your company. We start off everybody with 2. One is the executive summary. The other is the speed of cash, which is all the calculations I just walked you through. But then you can create any dashboard you want to. You can say, I want Ellen's dashboard, right? And go to Ellen's dashboard. And just make that. And when I do that, it's going to say, oh, this is empty. You need some stuff. So I click on Add Cards, and I can go through and add any card that I want to which means you're really focusing that client on things you want him to pay attention to, whether it be, inventory, whether it be a cash shortage number, his best sales month, it doesn't matter, gross profit margin. I can just say, hey, here's a couple things you did, right? Here's largest sales. I just do it 2, we'll say. And we'll populate it with whichever one you've got. So here's the one. Why it's important is that when you invite Ellen, I can invite her to view the account with me. I can give her no access to anything, keep dashboards on, and turn off all the dashboards except for Ellen's, right? So when Ellen logs in, now she can only see the one dashboard. She won't see everything else that's there. So each user that you have, and it's unlimited users, you can give them, any access that you want to view any page that you'd like.
So, Mike, just real quick. So, is this something that an accountant could use for all as a extra thing for his clients, or is this just me as a small business owner who has a couple of businesses? When you're saying you invite other people, what are other the options besides an accountant or?
Yeah, it's other options would be sometimes the banker. You can share access with the banker because we have a full document center that when we collect the data, we put all the documents that a banker would need right there, so you don't got to fax scan. You say, hey, I need the balance sheet, I need the income statement. You just say, hey, I'm gonna give you a login. You grab what you want.
Oh, okay. Okay.
Right. So I mean, and they're already there, pulled from QuickBooks. So, but with the balance sheet from December 2018. I can do that, and he can just open it up and use it the way he wants to.
But I didn't know if an accounting firm could have this tool and invite their clients.
That's right. Yeah, because what they'll do, Ellen, is I can just keep adding businesses, and every single account. Say I'm in a firm with 50, every accountant can have their own view with their own portfolio of clients. But then the other side is that they can also invite their client to look in at just their own. So every single person that's a user has a unique view.
Okay. A franchise could use this as well.
A franchise could definitely use this, right? Like we'll say a franchisee, is it Z or Zor? You guys, I always get
Zor. The Zor is the owner, the corporate,
right.
And then they could invite their franchisees.
Yeah. But the franchisor could see all 10 of his businesses right there on one page.
Yes.
20. Yeah.
Okay.
All right, so going back in, and I've got the executive summary. Here's the speed of cash cards, right? So right up front, I've got here's your cash shortage, right? I mean that's the top. That's the most important card. It won't go negative. It'll just go to 0. If you don't have a shortage, you'll just say 0. What's your cash gap days, right? That's the calculation that we did, and you say, oh man, Mike went through that so fast in Ellen's Tech Tuesday talk. What does that mean? I just click on explain this, and I give you the card and then a 1 or 2 minute video about what it means. So, yeah. All right. Yeah. So I mean, as you can see there, everything I just told you is better explained in the video, right? So all of these have like days cash on hand. Same thing. You just click on it and it plays. And I'm going to be just a little bit humble here and say, the star of the show is fantastic. I mean, he's one of the best actors I think I've seen in a while.
That's subject matter expert.
There you go. But average inventory, average customers, or AR days, AP days, it's already calculated for you. If you need the overview again, it's about a 3-minute of what this whole thing is doing. Here's the average cash gap needed, right? Here's the numbers. Working capital is $197,000. Average cash needed is $79, which means our shortage, of course, is how much? 0. We have more working capital than we have a need. So I don't know of another program out there that's going to tell you, when you need money or how you need money, but this is the one. So lots of ratios, lots of numbers, but lots of explanation as well. The cash flow calendar is visualizing, what your cash projections are going to look like. So we look at, cash coming in, cash going out, and we've got what's called cash learn technology, which is our patented algorithm to do projections. But then I said you've got complete control. Maybe you don't want to use our algorithm, you got your own method. You can use about 5 different methods, and you can choose it for each customer or each vendor. So this is just kind of the heat map, and where I always like to start is like just with settings, because these colors are a little muted. First of all, I can start the starting cash, change it. I'm like, oh, no, I've got all this money sitting here on my desk that I haven't done anything with, so I can change the starting cash if I want to. Or I can go to all the cash accounts and go, oh, no, that's a trust account. I can't include that. So you can turn off any cash accounts. You've got attorneys out there that have escrow money that they can't use as part of their operation, but they have to carry it on their balance sheet. So you can go through and turn off which accounts we use to actually count your starting cash. Then you've, of course, got a heat map where I can set the amount. Well, in the very beginning, I told you this isn't just for companies that have a cash shortage. You can set it at 0 if you want, or maybe you want to know when it's under, 100,000. Maybe if I do that, I want to know when it's 100,000 or less, and I want a cool color like that to tell me. Right, so now I can save it, and my cash flow calendar will change. You can see how all the colors change whenever it was under 100,000. Right, so I can know that all the way through. And this whole month is now free. but that thumbnail doesn't just change there. It will change back on your business as well. So if you don't like our colors, you can change it to whatever color you'd like. All the way down, you can see that. All right, here's my favorite part of it, right? If I want to add something in, I can do that. I can just add item. If this is an invoice that you have, right? So it's an invoice that we read. Each icon means something different. This icon means we have a prediction or cash coming in. This icon means we have it going out. But again, if you don't like, oh, no, we're not going to get to Washington Public High School, I can just turn it off and ignore it. And it changes the whole calculation as soon as you do that.
Mike, there's a question.
Yeah, go ahead.
Can slow pay bad AR be excluded in calculating?
Yeah, slow pay bad AR, that's right. Because on the detailed view, we're actually going to tell you slow pay. I don't know if there's any here, but there's I don't know if there's any. There's not one on this sample, but this icon here changes to late invoice. It'll have a clock on it, and it will be grayed out. It will look like this. We'll still show you that it exists, but it won't be included in the calculation. If you want to include it, you just say, yeah, include this, or don't include it. So sometimes you want it, sometimes you don't. And what we do is, there's got to be some, so all these are just kind of sample data, but whatever the real data is what we actually show. When you made the payments, how much the payment was, and then what we're predicting will happen next. Same thing with the cash out. If you see this icon, that means I actually created the transaction. So if I want to add something in, I can do that. I just go to, add item. I can add some cash in or add cash out, and I can add the item to make it happen. We can also do recurring, which means you can set it saying I want to pay this every 15th, or I got subscription revenue that comes in and this person makes it on the 10th. Even if the 10th is a Sunday, it will show it coming in that way. From the customers and vendor view, this is where you see it, where I can change the forecast method. Such as AJF, I can do it auto or manual. Auto is just meaning you're letting our program work in the background. Or manually, you can say, no, they always pay me 10 days after the invoice, and I can just change it to 10 days, and we will predict it on the calendar 10 days after the invoice date. Or QuickBooks gives us a number of average days to pay, and we can actually predict for each customer when they're going to pay based on their history. You can do it the invoice date, or here's where you can set the recurring. I can say, no, this guy pays on the first Sunday of every month. So lots of ways for you to predict when things are going to happen, and it changes the calendar view as soon as you do that. And we've got, of course, the same thing as the vendor. When you set a recurring, we automatically tell you, hey, this is recurring. Don't forget. the other cool thing here is some people say, well, it still seems limited. I can't do whatever funky calculation I want to, because you can already do what if scenarios with this, right? On the detailed view, I can just add item or go to the calendar view and say, what if I get this new contract? I can just go, okay, cash in, add item, new contract. I'll put in our new contract, the box, and Ellen's going to pay me $50,000.
Mm-hmm. I'll make it more.
Yeah, maybe more. But you can see how now everything changed. But what's cool is when I go to Excel, or I can do the same thing with employees, right? If I want to say, what if I hire 2 new employees? What does my forecast look like? You can see all the colors now change, where it's not that one payment by Ellen actually changed my whole month. And this is where you can start saying, what if I don't pay that on the 20th? What if I pay it on the 29th? And start managing cash flow that way. If you export to Excel, we've got a complete formulated and I don't know where it went. That's funny. I got 2 screens going. I don't know where the Excel went. It's probably opening up in the background. I just don't see it.
Probably.
All right. Not sure if that one works. It is opening up somewhere. Oh, there it is. Here's one. All right, found it. When you open that up, this is what the Excel, we take everything that we've pulled and we've analyzed and created a cash flow forecast for you in Excel. Even the colors are still going to be the same, whatever you set, the dates, the amount, all of that is already laid out for you when we think things are going to happen. All right, so, some people spend hours putting these together every month. Now you can just do it and spend 3 minutes, tweaking it the way you like it. We've got alerts and notifications. The last thing, or one of the last things, and things are overdue. If you have new customers, new vendors, this is where we also tell you when things don't look right. You can also use it like Facebook and post things to team members. Remember, there's a mobile app, a mobile companion. So if you go to the App Store and just type in Cash Flow Tool, all one word, we're in both Android and Apple. It's used more like a viewer Facebook, where the uploads are done on the desktop. Some people are setting reminders like, don't forget the tax bill, make estimated tax payment. Don't forget to send me your engagement letter, those type of things. They'll set reminders for folks where they get the push notifications on their phone. Then, of course, the documents, where we put in anything, or you can put in anything you want. Of course, and add documents to it. You got a terabyte of storage that comes with it. So if we're looking at pricing currently, back to Cash Flow Tool, I guess I should go to the pricing page. If you're just an individual, you've got Essentials, Pro, and Pro Plus. Pro Plus actually comes with quarterly consultation where, somebody on my team actually sits down with you and goes through it with you. It also has all of our training videos and things like that as well that you have access to. This is how it is, unlimited users and the works. So you can try it. Everybody tries the Pro plan because that has the most features, all the features, but you can try that. If you're looking for accounting pricing, if you're an accountant, we go by the number of clients you might work with. That popped down. Number of clients you might work with, which is up to 10. So it's about $25 a month per client. Up to 50 is 400, and then if you're after over 50, it could be negotiable after that. I do have a special. If anybody calls me right now, we're testing out. If you want to try it with 3 clients, it's $100. You just call me. It's something we unpublish. We don't publish. It's just something that we give on webinars like this. So I'm putting up on 5 minutes, so I'm sure I have no questions.
No, well, you had something. I was asking during the time, but if anybody else has any, feel free to ask. This is a great tool. Gosh.
Thanks. I mean, Yeah, we're actually trying to solve the cash flow problem, right? I mean, it's the one thing that keeps people from either getting loans, one, or two, keeps them from actually keeping the money in their business. You know, if you're the type of accountant where your client says, "Hey, you told me I made $100,000, where to go?" It's an easy way to show them where it went.
Okay. Oh, I don't see any questions, which isn't a bad thing. May have answered everybody's question, but I love seeing how I love the explanation first, and then I love seeing how the actual tool would work. So that's, as long as we've known you, this is great. I finally get how great this, tool is. Yeah, that's pretty awesome.
But the last thing I'll throw out there, Ellen, then is if you do go to cashflowtool.com, we have a tab for resources. Under the Getting Started is all the videos on, if I went through it too fast and you said, I don't understand how he did 1, 2, or 3, whatever it is, there's short videos on every single feature that we have. We also have, if you just, don't like us for some reason, you want to just have the Excel template, you can just get it right here. You can just download the Excel template. We've got all of the financial formulas that we're explaining them. We're telling them, why do you care? What does it mean? Putting short videos in about them. But yeah, we've got everything that you need to understand financial analysis and ratios together.
Mike, I have 3 quick questions. I do have questions. They came in. Here, the first one, you said 3 clients per month is for what version?
That is, you get the accountant version, which is the essential, the pro, which is the most, it's all the features. So you get the pro version, but you can use it with 3 clients.
Okay. We have a question.
And the only way to get that is, you got to reach out to me to get that, though. It's unpublished.
Okay, and that's fine. And then if you need his information, you can contact me. So, and I'll put my screen up there real quick, or just contact out of the box, even through our website. But we'll get you with Mike. Can this work with a construction company?
Absolutely. As a matter of fact, we're actually, if anybody's heard of Procore, they're the #1 job costing, and we're actually getting ready to do a partnership together for what they're doing into QuickBooks and out. So, I mean, with the construction company, they chose us as their cash flow vendor, as part of their ecosystem.
Okay, and someone's asking about how we can get the deck. So I'm just putting, what's your email, Mike?
It's Mike, Mike, M-I-K-E, and I'll put it in the chat too, at Mismanagement.com.
Yeah. Okay, and mine is, that's mine, and my phone number.
Oh yeah, I guess I can do that too.
And yeah, that's mine.
There you go.
That's mine, yeah. And there's Mike. There's his. So Mike's desk. There you go. So, oh, this is really informative. This was. I'm glad Jennifer wasn't here so that I could listen in on this. This was. That's our little secret. No, I was just saying that I really loved listening in and learning on all this. This is great. So.
Well, Ellen, I've been begging you to let me work with you.
I know, and so it finally worked. So there you go. So that. So yeah. So I'm just going to do this real quick here, Mike. I'm going to just put myself back as the presenter here,
sure.
And sure. I just want to talk real quick about. Oh, we've already went through the Q&A, so that's awesome. But we have tons of Technology Tuesdays coming up. It's about one every week, and a lot of them are this year are focused on our services because we have so many, and we're still just trying to get the word out about all the things that we do. So if you're interested in hosting QuickBooks, what does that mean? It's not QuickBooks Online. It's QuickBooks in a hosted environment, desktop version in a hosted environment. But we can tell you about that. Our custom reporting is happening in March, Alpha 5. We do website designs, even our consulting services. We're going to have some of our consultants on talking about what we do. then how you can become a client, like what are the processes that you go through, what we do. Avalera is going to be on, Recur 360 again, and our bookkeeping services. So we send out tons of emails, and I know you guys get them about what, when all these webinars are coming up, and they're on our website too. So oh, there's my info again. So thanks, Mike. Thanks, everybody, for joining. This has been, a really great presentation, lots of info, and you know how to get a hold of us if you want more. And we'll have the recording of this as well up on our website probably by tomorrow. Usually Jennifer turns it around. So awesome. Thanks, Mike. Appreciate it.
Thank you. I appreciate it, and I will talk to you soon.
Yeah, sure will. Okay, everybody, have a great Tuesday and the rest of the week. Talk to you next week.
Bye-bye.